Hello everyone, welcome once again to JD's Guidance. Friends, we are discussing about the portfolio performance, and in the previous video we have covered a very popular technique of portfolio performance, and that is your risk adjusted returns. So what we are basically trying to see is that how can we see how good your portfolio is performing. So the risk adjusted measure we have seen in the previous video. Today we will see one more popular measure of performance of a portfolio, that is the famous decomposition of performance. So friends, this method is basically it believes that whatever is the return of a portfolio is coming because of some risk-free return, because you are getting a return which is over and above the risk-free return plus excess return. Let me explain you what does this mean, excess return. I want to tell you the fact that since you are investing in a market, and in this market you have invested in risky assets, you are taking risk, so you must get some extra return because you have taken risk. So how much extra you will earn is your risk premium, right? This is your extra or excess. This excess you are getting because you have taken the risk, but you must get something which is minimum, which any investment without risk gives you. If you have put your money in a very safe kind of investments, maybe bank or government security, there is a fixed return that you will get, and it is devoid of any risk. It doesn't have any risk. So whenever you are investing in a risky asset, you are getting something extra. Why you are getting extra? Because you have taken risk. So extra over what? Extra over the risk-free rate. So I must get the risk-free rate, but over and above I must get something extra because I have taken risk. If I have not taken risk, I will not expect any excess. I will just be happy with the risk-free return. So that's the point here. So your portfolio is generating something which is any risk-free asset gives you, but since you have invested in risky assets, so you get something excess. Now this excess return, as I have told you, is because you have taken risk. That because of this, because you have taken risk, it could be so that your asset selection was the best. In your portfolio, you selected some such assets because of the performance of those assets is such that it gives you some excess return. So I would call it as asset selection. Asset selection. Okay. So now you know that risk has got two parts. One is the systematic risk, and the other one is the unsystematic risk. So friends, systematic risk is that risk which is non-diversifiable. You cannot diversify, and therefore there is always a risk, and since you have taken the risk, you are getting an excess return, and that's why your portfolio return is something more than the risk-free return. But what about unsystematic risk? Though in the literature of finance we believe that unsystematic risk can be diversified and there is no risk as such, but in reality there is of course some degree of risk with the unsystematic part also, because any portfolio cannot be diversified to 100%. So there is always a small degree of risk which remains. So this is the unsystematic risk. So friends, what we can see here is that our risk return is decomposed. It has been dissected into different parts. So I call this at RF. Let's call it as RF. And this excess return has got two parts. Okay. Let's call asset selection as R3. Okay. And then the systematic risk, I call it as R2. Why R2? Because that is related to the market. That is related to the market movements. And that's why let's call it as systematic or R2 risk. Whereas unsystematic risk, let's call it as R4. So friends, we have got so many components of total returns. First is the risk-free return, RF. Then we have the systematic risk of the market. Let's call it as RN, because in our previous lectures we have always used the notation RN. So this is risk-free return plus what the market return is generating, because you have taken some systematic risk. And let's call the asset selection as R3. and let's call the unsystematic risk as R4. You may call it R1 and R2 also, but since I have already written, so let's keep it as R3 and R4. So we have this decomposition. Now let's see how can you find out the values of this. Let's talk about the first one, risk-free return. So friends, risk-free return you cannot calculate. You have to find out in the market what is the rate prevailing for any secured investment, 100% secured investments. Take for example government deposits or government securities. How much return it is generating for you. Okay. Now coming to the market return, you already know what is the market return. So market return is how much RM minus RF, because you must get something more because you have taken some systematic risk. How much more is the difference between how much you get from the market minus how much is your risk-free return, and you multiply that with the beta of your portfolio, then you get what is your market risk. Right friends? So we got RF from the market, we computed the market returns by finding out what is the difference, that is the margin, or you can say what is the reward, market risk minus risk-free, then multiply with the beta of your portfolio. Coming to R4, let's talk about R4. Friends, R4 is what? R4 is unsystematic risk. How can I capture the unsystematic risk? See, if you have total risk and if you minus the systematic risk from the total risk, if you minus the systematic risk, what remains is your unsystematic risk. We have seen that the total risk has got two components, systematic and unsystematic. So if you minus the systematic, you will get unsystematic risk. If you minus the systematic from the total risk, you get the unsystematic risk. Let's see how can we find out. So friends, you all know that total risk is calculated with the help of standard deviation or variance, whereas systematic risk is calculated with the help of beta. We have seen that. So how can you calculate this R3? So you can see here, I'll just write here first, then I will take it there. R3 means the, sorry, we're talking about R4. Let's say R4, that is this one, that is unsystematic risk. If your portfolio has a particular risk, right? And this risk means what? Standard deviation. You find out what is the market standard deviation. What it will give you? It will give you what is the portfolio risk in relation to the market risk, the total risk of the market, and how much is the portfolio risk, right? Or you can say what is the portfolio risk, I mean per unit portfolio risk as compared to the market risk. Okay? As you know that from standard deviation, if you minus the beta of the portfolio, I will get what is the unsystematic risk, right? So I got the risk component, but I have to multiply with the margin RM minus RF. This is because why? Because we are talking about returns. So returns is this much. But this much, out of this much, how much is because of unsystematic risk? You minus the systematic from the unsystematic, you will find out what is your R4. So friends, R4 is this. So you can refer to R4. Coming to R3. So what is left? RF we got from the market, RM we applied this, R4 we applied this, now left is your R3. So R3 is what? R3 can be obtained by, see if RP is the total and total has got RP is equals to this plus this plus this plus this. So R3 is equals to this minus this minus this minus this. So you can find out what is the residual or residue. Means you can find out total returns of the portfolio minus the risk-free return, minus the market return, minus the unsystematic component. What you get is the balance is your returns, which is simply because of the asset selection. Fema calls this as pure selectivity. That means the excess return which has come due to the asset selection. Asset selection was best, that's why you get. So R3 is your pure selectivity. Now there is another concept called net selectivity, famous net selectivity. Now famous net selectivity says that how much return you are getting in the portfolio minus what is your risk-free return you find out minus what is your risk that you have taken. I mean, you please try to understand this. What is your total return of the portfolio? From there you are minusing certain things. What are the certain things you will minus? How much return you are supposed to get. You are supposed to get risk-free return, plus you are supposed to get some return because you have taken some risk. So what is the return for taking some risk? We have measured it by this RM minus RF, right friends? So if you minus, if something something is left, that is known as Fema's net selectivity. So what does this mean? This means that whenever you are earning some return, okay, the total return is this much. Now this return is because I must get some risk-free return, okay? This return, I must get some risk-free return, plus I must get some return for taking some risk. So total risk, you know, the total risk is portfolio risk divided by the market risk will tell you what is the per unit portfolio risk. Multiply with the premium that you are receiving. This will give you the total returns due to total risk. Returns due to total risk you have taken. This much risk you have taken because of which you have this much risk you have taken because of which you have got this return. So the total return is because of taking risk. And this is because you must get over and above something which is risk-free. But still something is remaining. That something is remaining is known as Fema's net selectivity. So friends, that's all for this video. Here we have seen that Fema has decomposed the total returns into so many components, and he has very clearly pointed out how we can capture each of this. So thank you for watching friends. We will now move on to the third technique of measuring portfolio performance in the next video. Till then, goodbye.